Hey guys, we are here from Moneydhan. Today, we are diving into a topic that's been buzzing in the comment lately bonus shares. You have asked for it, so here it is. But let me tell you, this isn't just a basic breakdown. By the end of this video, you will know exactly what bonus shares are, how they work, and why big companies issue them. We will cover the concept of bonus shares, what they really mean, how they create value for shareholders and investors, and most importantly, key indicators that signal which companies are likely to issue them. Now, let's jump right in. So, what are bonus shares? It's simple. They are free shares a company gives its existing shareholders. For example, a 1 is to 1 bonus means you get one free share for every share you already own. A 3 is to 1, that's 3 free shares for everyone. Sounds fantastic, right? But there's more. To claim these bonus shares, you need to know about the record date, the company's cutoff date for eligibility. If you hold the shares in your demat account on that record date, the bonus is yours. Miss it or you miss out. Stay with me because this video will arm you with the knowledge to spot opportunities and take advantage of bonus shares like a pro. Let's get started. Alright, let's talk about a big question everyone has. Do bonus shares increase the value of your investment? Not really. But hold on, there's more to the story. Let me break it down for you. Imagine you own one share of a company, price rupees 1000. Now the company announces a 1 is to 1 bonus share. What does that mean? You get one additional share for free? Sounds great, right? But here's the catch. The share price adjusts. So instead of 1000 per share, the new price becomes 500. Why? Because the value of your total investment remains the same. Let me simplify. Before the bonus, you had one share worth 1000 rupees, that is total 1000. After the bonus, you now have two shares worth 500 each, total 1000 rupees. So, what's the big deal with bonus shares? Is it just hype? Not quite. Bonus shares serve a strategic purpose. Let's dig deeper. Here, what happens? High priced stocks can feel out of reach for many investors. Think about it. How does it feel to buy just one expensive share? Not great, right? Now imagine that same stock gets a bonus and its price drops to a more affordable level. Suddenly, it's accessible to more investors. Here's an example. A company declares a 9 is to 1 bonus. For every share you own, you get 9 more. That means if the share was 1000 rupees, the price adjusts to 100 rupees. Now, wouldn't that catch your attention? It's the same stock, the same company, but now it feels like a bargain. And here's the magic. When more people can afford a stock, demand skyrockets. And when demand rises, so does the price. So, why a 1000 rupees share might drop to 500 rupees theoretically, the surge in demand might push it to 550 rupees, 500 rupees, or even higher. That's the real power of bonus shares. So, what's the takeaway? Bonus shares might not directly increase the value of your investment immediately, but they can create demand and open doors for price appreciation. That's where the magic happens. Got it? Great. Let's move to the next point. Now let's talk about one of the biggest success stories in the Indian stock market, Infosys. If you're wondering whether any company has given massive bonuses over time, the answer is a resounding yes. And Infosys takes the crown. Let me walk you through this step by step so you can truly understand how bonus shares can transform a portfolio over time. Infosys launched its IPO back in 1993 at just rupees 95 per share. Now imagine this, your parents bought just 10 shares at rupees 95. That's an initial investment of rupees 950. Nothing extravagant, right? But here's where the magic begins. Infosys has issued bonuses not once, not twice, but 8 times over the years. Here's how it played out. First bonus 1:1, your 10 shares become 20. Second bonus 1:1, 20 shares double to 40. Likewise, eighth bonus 1:1, your final count becomes 5,120 shares. Now let's crunch the numbers. The current market price of Infosys is rupees 2000. Multiply that by your 5,120 shares and your investment is now worth a staggering rupees 1 crore 2 lakh and 40,000 rupees. Yes, you heard that right. Your 950 rupees investment had turned into over 1 crore. Think about that for a second. An initial investment of less than 1000 rupees turning into a 1 crore is the kind of growth most people dream of. Mind blowing, isn't it? But here's the key takeaway. It's not just about bonuses. It's about staying invested and letting your portfolio grow over time. Infosys didn't make you rich overnight. It rewarded patience and persistence. This is why you need to understand the power of long term investing. And trust me, we are just getting started with how you can apply this to your portfolio. Let's dive deeper. Let's dive into the big question. How do you identify if a company is likely to issue bonus shares? There are certain parameters you can evaluate to spot these opportunities. Let me break it down for you step by step. Is the company consistently profitable? This is the first sign. If a company has been generating continuous and increasing profits, it's a good indicator. Why? Because higher profits usually mean the company's reserves, its saved up earnings, are also growing. But what can a company do with these reserves? Well, they have a few options. Option 1, pay dividends to shareholders. Option 2, use the reserves for expansion, grow the business, build new plants, or enter new markets. Option 3, issue bonus shares to reward shareholders. Option 4, go for a buyback, reducing the number of outstanding shares in the market. Second, thought process of the company. This is critical. Some companies prioritize rewarding shareholders through bonuses or dividends, while others focus on reinvesting profits to fuel growth. For instance, tech giants like Google and Microsoft rarely issue bonus shares. Why? Because their strategy is to reinvest profits to expand and grow at a faster pace, 15%, 20% or more, rather than paying it out as dividends. So, to predict bonuses, you need to understand the mindset of the company's leadership. Are they more focused on rewarding shareholders directly or reinvesting for future growth? Third, past history of bonus shares. Here's a simple rule. If a company has never issued bonus shares in its history, the probability of it issuing one is very low. On the flip side, if a company has consistently issued bonus shares in the past, it's more likely to continue doing so. Fourth, profit margins. Lastly, look at the product margins. A company with high margins is likely to generate greater profits, leading to larger reserves, and larger reserves increase the probability of bonus shares being issued. In conclusion, identifying companies likely to issue bonus share isn't just luck. It's about understanding their profits, reserves, thought process, and history. Companies with consistent growth, high reserves, and a shareholder friendly approach are prime candidates for issuing bonuses. But remember, bonus shares are just one piece of the puzzle. A company's ability to grow, innovate, and sustain profits over time is what truly creates value for investors. So, while bonus shares can be exciting, always focus on the bigger picture of long term wealth creation. Keep these parameters in mind, do your research, and invest wisely. And who knows, you might just spot the next Infosys story in the making. Stay curious, stay invested, and I will see you in the next video. Bye.